Thank you for the invitation to speak. As introduced, my name is Raphael Agung. I work for NCBA, and we're very grateful for the partnership at Abojani. And let me at the outset congratulate you for this fifth economic forum. Ownership economy is the theme, and self-sustenance. I was here last year. So as I understand it, Abojani is in the Ministry of Financial Literacy and encouraging financial prosperity, wellness. And I thought as an entry point, I should speak more to the literacy bit, which I think economics has a lot to offer to. And using that lens, since we are all students of wealth and investment, we can use that to sort of take a scan at what the economic and investment theme for 2025 has been, and then try and quickly look at potential themes that will impact your savings or investment into 2026, as understood the brief. All right. So if you think about it, finance or economics as strictly just about 6 functions. More broadly, either, and the most dominant one, of course, being facilitating payments. So all of us make some payments one way or another, and we have different platforms these days for doing that. Technology has really made that easier and more innovative. We keep seeing that almost every day. So as a key function, I don't think it's very relevant to what's top of our mind today. So I won't go into that, but I just sort of thought that that should be placed out there for prudent context. The second, of course, is something that I think even our RBA colleagues have spoken to already, which is dividing or creating asset classes and being able to divide them in ways that allows, again, ownership in small bits and pricing them accordingly. So those on the asset management side may be very familiar with this. And some of what the previous speaker referred to primarily sits on that second function. The third function, which I think should be our intro into today's conversation regarding ownership economies or broader investment themes, is one that I want to spend a minute or so on. And that is transferring resources across time. If you think about it, there was, those who were attentive to the previous speaker, he quickly rushed through an element of compounding and how that creates wealth in, I think, is slide 2. Most of the time, there is this nexus of savings and investment that the whole discipline of finance addresses in terms of making that as efficient, as optimal, and as valuable as possible. And for us to understand that better, we need to at least agree, and they're commonly agreed sort of understandings of what is wealth vis-a-vis income, but more importantly, what is actually money, and how do we price money? Because if we can agree conceptually on what those are, then I think understanding the road we've traveled in 2025 in terms of broad macro themes, be it global or domestic, and then trying to assess how you will be allocating your own little wealth or trying to manage your savings in 2026 will be much easier. So the money, standard textbook economics is the only bit that I'll speak to, defines money's functions in right about three functions. The first is very important because it's actually a scorecard of who has more or who has less or who has more value or who has less value. And that is that money is actually a unit of account. So it's a unit that helps us count success, prosperity, value, whichever adjective you want to use at every point in time. Every polity or every country has a currency, like Kenya shilling or Europe and whatever, and that unit helps us then account for value. So money is essentially, in the first instance, a unit of account. It's also a medium of exchange, right? You can imagine in the olden times, barter trading, when we didn't have the invention of money, you'd have to have what we call a double coincidence of wants. For me to get a cup of tea, and I only have a commodity on the other end, the seller or the owner of the surplus tea must necessarily want that commodity I have, and made trade very difficult. So to eradicate the double coincidence of want, money became a very good, commonly agreed medium of exchange. And that's very important as well. But why am I going into this? Because whichever of those functions of money you take, at some point we have to attach a price to it. And the price of money, again, is in three forms. All right, you either have to value money in terms of time, which is why I pose on the third function of finance, sort of transferring resources across time. So if you think about it, and I think because you've been to financial literacy classes, master classes by Robert, probably taught you about time value of money, all right, as a very essential point, which I think even the previous speaker was alluding to. It helps you grow value and become wealthier. So the price of money in terms of time is the interest rate, right? And so those of you who invest, if you come to us as banks, we price your deposits and say, I'm going to pay you X by an interest rate. And that price is so important because that key variable then determines our fortunes from day to day. But there's also the price of money in relative terms. So the price of money in Kenya relative to the price of money in Uganda, or for argument's sake, the US. So the price of money in relative terms, comparing different polities, of course, is the exchange rate, the key variable. And then you have the price of money as a reflection of the value of commodities we consume at a general point in aggregate terms, which in our world we call inflation, the rate at which the general level of prices of whatever we consume. So there are three key things that I think almost at the back of our mind we never think about explicitly, and I'm surfacing them frontally for ease of understanding, but they guide every investment choices we make. And if we are to create ownership societies or self-sustenance or financial freedom, as it were, which as I understand is the vision of that, that ordains pretty much how we think about the investment terrain. Now, there are two ways in which macroeconomic policy is conducted. The two broad ways, there's how we tax and spend, how we tax your money and we spend it, that's the fiscal policy side, run by the executive arm of government, and then there is either side, which addresses the actual price of money question, monetary policy, and that's what I want to stick to. The fiscal side tends to be murky, it's broader, it doesn't speak directly to your day-to-day investment decisions in terms of personal finance, but it is related, so to the extent that it affects some of the things I'll speak about, I think I'll refer to that. I'm conscious that I'm speaking 2 days after the State of the Nation address, and there was a lot of fact-checking yesterday, so the economic scorecard is out. I hope I can speak without contradicting some of that. I'll try to be pretty polite, but I'll stick to the monetary policy side mainly because I think it's going to determine how you decide what investment classes to play at, or how your own personal wealth has performed this year, and for what reasons, for that matter. So Nelly is our head of marketing and communication. They're very organized, and so they insist that when we show up in a very clear sense. So let me use part of what may organize my thoughts better, which is 2 or so slides. Okay, 2025, in terms of, and basically the introduction that I made, just use that and in terms of following, try and see how those three elements of price have been managed and how has it affected your investment fortunes or lack thereof, and how is it likely to be impacted by any investment themes that we'll sort of be teasing out going forward. So let's start global. And it's interesting that we used to think that Kenya is immune from global trends. I guess the rate of globalization or deglobalization, wherever you look at it, has disabused us of that notion. So our fortunes are pretty much directly tied to the external world in ways that perhaps we need to pay even more attention to. I think for Kenya, it became even more dramatic when about 5 or 7 or 10 years ago, we went into the international capital markets and issued a couple of Eurobonds, some of which is still part of our outstanding debt or outstanding debt stock to date. And so to the extent that we have public debt, almost 50% of our entire country portfolio, in foreign currency, specifically in dollars, it just means therefore that the price of the dollar, the interest rate on dollar, is consequential to how wealthy or not Dr. Ruto will get us to Singapore, or with pace at which he'll get us to Singapore. Okay, so it's important that we pay attention then to U.S. monetary policy. Unfortunately for us, or fortunately for those who are news buffs like me, lots of drama, lots of yin and yangs and yo-yoing every time. The news has been very juicy most of this year, not least of all because of the election of Donald Trump. All right, so if you think about the key theme coming out of the global side, it's been Donald Trump and his tantrums for the most part, but his maverick style of economic governance. But more particularly, if you're paying attention, it's his attempt to actually rewrite the global economic order as we understand it since World War II. All right, we've had pretty much a very stable, agreed financial architecture that guides the economic world since 1945. Donald Trump is attempting to rewrite that, predominantly making the argument, sometimes plausible in some quarters, and that the trade system has been rigged, and particularly rigged against America, and so he's trying to make sure that he rights that wrong. And to the extent that American economic policy is still consequential. Keep in mind that America is still by far the wealthiest. Don't make the mistake of thinking that the buffoonery that the Trump White House spits out every day has somewhat reduced America's economic heft. It's still pretty much 25% of global GDP and will remain so for a while, notwithstanding the challenge coming from China or anywhere else, particularly India. So he's attempting to write that. That has meant that the external world has had significant turbulence, all right? Policies made on Truth Social or X, and it's reversal after reversal. More dramatically, if you go back to April, we had the Liberation Day. America has been apparently enslaved, and so Trump was liberating them in April by what he called reciprocal tariffs. I've not seen attempting to write that, but that's for those who are interested in that literature. The point is that despite that, in our discipline of economics, I don't think there's any disagreement that Trump's economic policy making were potentially inflationary, the tariff structure and what have you, and would be hurtful to growth. And therefore, the assumptions we were making for 2025 was that growth would be, perhaps would take a big hit. That's growth. When I talk about growth, I'm referring to just actual output numbers in terms of total goods and services produced up in output. Now, incidentally, despite that, growth has remained very resilient. So by all counts, we have it on authority. This is November. At output level, aggregate output level, global growth is likely to close at about 3%, which is fairly decent, 3.1%. That's pretty much what we've seen. That doesn't take away that even though that headline is great, there's been significant turbulence. And for your purposes and my purposes, it's meant that a lot of asset classes have sort of replayed that noise in trying to determine what Trump and the White House will do, how will it affect the price of dollars, US monetary policy to be precise, which is the interest rate in the US, in making those guesses on a day-to-day basis. If you follow, like Robert and team, if you follow asset classes, there's been significant volatility, whether you're looking at equities, whether you're looking at fixed income side, there's been significant stampede into gold, and there's reasons for that. And a host of them have reflected this noise. That notwithstanding, we still have great outcomes at the aggregate output level. And sometimes this is a problem of averages. Average can be great, but people have really suffered in between, even as you head on to that. So how have we fared taking from the external side? I think if you look at Kenya, for instance, since you live here, and I think maybe that would be more closer to you, it's been pretty resilient. And so sometimes when we speak to this, it sounds as if you are providing an apology for government, but facts are the economy has been very resilient, right? So we expect that for 2025, out of that resilience, our output growth number is, again, going to average just about under 5. We have up to Q3 on a leading indicator basis, and so profile we see growth. The interesting thing for us now in the investment, personal finance or investment world, which is, I think, the crowd we have today, the prices, and this is the reason why I was introducing them, which have direct bearing for your fortunes, your investment or wealth fortunes, have also been remarkably stable. So we can argue how much we want, and I know Kenyans are very passionate about their welfare today, especially using the economic lens, so I don't want to rile up anybody, depending on which side of the political divide you come from. But the truth is, the prices have been remarkably stable. The three of them, if you remember, I introduced them early. Price of money in terms of time, interest rates have been stable. All right? Actually, if you look at the monetary policy stance, they've been slowly coming down, cumulatively just up to about 9.25% as we speak today. So significant drop in interest rates. If you look at treasury bill rates, that's been coming down, slowly undulating. So pretty good. The exchange rate has been remarkably stable. All right. In fact, arguably at a standstill. In fact, disturbingly stable from my side of things, because it tells me that the external side has, has some sort of frictions that could be stirring up, that perhaps could come out in unexpected ways. This week alone, by the way, there was some movement there. So it's interesting. We had about 70 cents movement on the dollar shilling rate, which since reversed back, but I'll come to that in a moment. And then inflation has been low and stable, 4.6% as we speak. That's the general price levels. I know we don't eat inflation, we don't eat GDP, wealthy, and you can dismiss me how much you want, but those are the facts, right? So we've had growth within the context of very stable prices. What monetary policy, or the job of the administration, at least on the monetary policy side, is actually to do exactly that. Give us as much output as possible with low and stable inflation and generally stable prices. So in terms of the macroeconomic stability equation, I continue to argue that the facts perhaps are in Dr. Ruto's favor, or shall I say, Kamau Thuge from the central bank. And why is this important? Because it's those three, and particularly the views you take of monetary policy, that are going to inform the investment choices you make, and then potentially determine whether you succeed or not in your pursuit for the self-sustenance question and or wealth enhancement. Now, there's a litany of staff there. I've spoken to them, mostly in a roundabout way. But it may be remiss on my part not to point out this. There's been a raft of also significant policy developments within the monetary policy side, which is on the savings and investment question. You recall that we've had a problem in Kenya of the state of the public sector crowding out the public sector and making us less wealthier, if you want to be. So in terms of addressing that, what I call our fiscal challenges, there's significant development from the Central Bank of Kenya still ongoing in trying to revise the credit pricing framework. So some of it already is in place. The monetary policy framework has reviewed, and even with that revision in terms of the policy rate, we're getting a framework which potentially is going to aid the advancement of credit to the private sector. Now, that's important for savers or investors or wealth managers, or even at a personal level like you and I, ought to pay attention to that, because in terms of the ultimate or aggregate quantum of loanable funds that Kenya has, in the allocation of that capital at the personal household level, at the macro government level, how that variable moves is very consequential to the choices we will make. So please pay attention to that. Now, I'll quickly turn to a lens into 2026, and then I think the last slide speaks to some potential investment themes. So I'm winding up. I'm conscious I have 8 minutes, so thanks for the time. What do we see in 2026, global and domestic? On trend, for the most part, we think that just given the momentum for 2025, the choices that have been made, global growth will average about 3.2, again, still powered by the US. Whether we like Trump style or not, that's pretty much where still some, let's say the center of gravity is still oscillating. Although if I had some time, I think it's debatable whether American dominance is gonna survive the next while. There's pretty much significant currents, including potential challenges of the dominance of the dollar that I think any allocator of capital or anybody managing their personal wealth needs to pay attention to. I think you've seen the move into gold as a reserve sort of solution by central banks is going to affect perhaps. And I should have mentioned, by the way, that in terms of that 2025 theme, holistically or just around the clock, the dollar was weaker across the board. It was weaker against the shilling, remains weaker against the euro, pound. So dollar weakness was a theme in 2020 this year, and I think potentially into 2025, and is being informed by significant attempt to wrest this control of dollar dominance, which I think has given America a lot of privilege, sometimes that I think in ways that they don't appreciate. But be that as it may, I think we see Europe pretty much playing catch up. I think the empires there lost their hue, and I don't think it's coming pretty soon. Perhaps you can look east, perhaps in India. But at an aggregate level, we think that's how growth pans out. Kenya, again, on trend. If you look at the bottom-up economic transformation, then if you look at the real sector outcomes, so if I run away from my monetary policy lens and I look at just real sector outcomes, there's just 3 ways in which you organize the economy. If you look at industry, you've seen slow sort of reversal of fortunes in manufacturing. Agriculture, we've had good weather, thank God, and may that long continue. That tends to define Kenya's exploits a lot more directly in ways that's understated. So at just 23%, 24% of GDP and agricultural growth, given what the weathermen are telling us, should power on just fine. And then where we all sit, perhaps those of us from financial services, that remains very well diversified and also is pulling on very strong. Insurance, financial services, ICT, what have you. And so in aggregate terms, that should give us Kenya's growth number at, again, just 5, maybe 5.2% at best. Sort of whitewashing the key challenges that I think for those who are maybe curious enough, you may pay attention, which is how the plan by Kenya Kwanza is implemented ahead of what is obviously an election season in 2027. So you'll be allocating or managing your savings in a pre-election year. We have enough historical data points that tell us how Kenya's broader macros have behaved ahead of election. It may be important to pay attention to the earthquake or surprises out of Tanzania, and we have a key potential event risk question out of Uganda. That's part of why the currencies were behaving as they were doing this year. And then we have Kenya in 2027. Generally, it's always hampered GDP growth. So that's partially the reason why the 5.5 we are not as sunny as, for instance, the official accounts are projecting much higher growth. But I think it may be fair to say that the only problem there is, I think we are going into this election in a completely radically new political economy context. That's my vernacular for saying the political terrain has changed in ways that it's not clear to me whether an incumbent, a very energetic, eloquent, and very hardworking incumbent facing an electoral cycle where a dominant organizing pillar vanished a couple of weeks back. So it's not clear to me whether that tension or how we find a balance on how Kenya is approaching that election and the levers of power will play out, because how we answer that supposition is very determinate or is very consequential to what will happen then to the two levers of policy, be it particularly monetary policy, but also fiscal side in terms of just expenditure frameworks that I'll go through. So pay attention to that. I don't have a crystal ball there. I just think that as things stand right now, we have a sort of terra incognita. We've not been here before, where you have an incumbent that's pretty strong in terms of political terms, but basically has a quickly reorganizing political ember, a bit of it. So that's how we see Kenya outlook. I think I have a minute to go, so I need to run. On the investment summary, so what does this mean for the different assets? A couple of themes. Understand, of course, I've spent a lot of time there. I think pay attention to Truth Social and X. That's where policy is made. Donald Trump will still be consequential, so please pay attention to the tweets. I think, paradoxically, I think if you go back to Liberation Day tariffs of April until today, almost everything is back to just over 10% from the tariff process the US is taking. So it's a lot of noise, but actually very little movement. It's a shocking thing when you pay attention to Trump. I think risk management is unquestionably going to be the game in town. And this is where I think the financial literacy mission that Abujani has invested its institutional life to is very important. So risk management here means if you look across asset classes, how you allocate your savings, monitoring the movement in interest rates, if you have external exposure, exchange rates, and what have you, it's going to be essential that you pay attention to whoever is managing your money. Robert and team, I think they need to pay spectacular attention because the volatility is not about to change. And then the new theme that has a consequence for us at the broader macro level, but also it's both in terms of just the productivity gains that we like to see, is artificial intelligence. I know that word is stated in every presentation. I take very little from it except to say that it's changing the productivity game in ways that perhaps may even make our forecasts, as traditionally understood, the 5% that I'm doling out very confidently. We don't know yet the extent to which this huge equities influx into artificial intelligence, particularly in the OECD countries, could ramp up the potential, what you call the fiscal capital capacity for every economy, and therefore perhaps inspire broader growth. So I think as a theme, that's important that you pay attention to. But overall, I think that's where we are. I think I've gone on longer than I should. So thank you very much. Yeah.